shape. We are recording, we are screening, and we are everything that we need to be. All right, Mr. Maestro, please.
Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither BillStockWorld.com, CSW, nor its affiliates, nor any of the respective officers. Personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. CSW provides education and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on its specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
All right. So how is everybody doing today? I hope everyone had a nice weekend vacation. Hedge funds moving to gold and Bitcoin. Doesn't take many people to move into Bitcoin to create a bubble there because it's such a small basis. I forget the number, but 40 billion, something like that, is the total of all cryptocurrency, or now it's 80 billion because it doubled up. It's nothing. I mean, Apple, it's Tesla. It's like if the whole market was one stock, of course it would go up like crazy. That's the way it is, unfortunately. So let's see. What's going on? Where's my thingy? Aha. All righty. So we're zigzagging up and down, but nothing very exciting. Generally, we were talking about the 5% rule earlier, so let's take a look at that. Well, first of all, let's look at this. Everybody's down a bit. Nothing serious here. Nikkei's still up a little bit. Natural gas is down here, 312. Ooh, that's a funny entry point. Gasoline, we entered this morning. Oil, we entered this morning. We'll talk about that too. The dollar is very, very weak. Gold is pretty high. Silver is pretty high. Coffee pretty low. Coffee's a good buy here. So a couple of things to do and buy and do all kinds of stuff. So what I say we'll talk about. We'll talk about the 5% rule for a moment, then we'll get back to some futures. Okay. So this morning, we liked oil at 48.50. All right? So I liked oil over 48.50, and I bought some here. And now, if you're playing it properly, there's two ways to play it. I'm a conviction player. I never advocate people do this because it's very expensive. But it's, I play with conviction because I have conviction when I pick something, and also because I have an account big enough to withstand a substantial loss. So the way I said to play it is to play a move above the 48.50 line with tight stops below. So here you got a little move, nothing you'd probably cash in on. It goes back down. You would stop out here with a small loss. Does it go back over 48.50? No, it does not. Then you wait. Then you can come back in at 48. And now we get a move from 48, and it comes back down. You get out with a break even or loss. Then it goes back down here, comes back up. You play the move above 48, and now look what happens. A $500 winner. All right, that's playing without conviction. That's playing using sensible, tight stops. And for anybody who's not a pro trader, who's been doing this for years, is supremely confident and can afford to lose $10,000 or $20,000 and just sort of laugh. I don't want to say laugh it off, but you know what I mean. It's like, as I often say, okay, if I lose $20,000, it means instead of going to Europe, My kids and I will go to like Florida and see my mom. That's the difference in my life between winning, $20,000. I'm not going to go to Europe this summer. And by the way, and that's a discipline you have to have also. If you lose some money, you've got to make it up. You can't lose money out of your investing money and not make it up. Okay, your whole life, the purpose is you always sacrifice and do whatever it takes to keep your investing account moving forward. And if you take a loss in your investing account, you have to do something in your personal life that will put that money back in your investing account. Don't let your investing accounts get off track. That's the way it has to work. So when you lose $10,000 in your investing account, you need to find a way to save $10,000 more over the next 6 months or so and put it back in the investing account. You can't act like it's okay. It's not okay to lose money in your investing account. All right. So then that determines what kind of risks you should be taking. If you don't have good cash flow, I have good cash flow. I make a lot of money. So for me, I have good cash flow, so I can absorb a $20,000, $30,000, $40,000 loss and come back from it. If you can't, you shouldn't be. Then it's an unacceptable loss to you. Then you have to play differently. You can't play things that even open you up to the possibility of having a large loss if you can't quickly put it back in. Any kind of short-term trading like this is always gambling. Always remember that. So unless you can easily afford to lose whatever, tight stops is a way to learn. And that's an important, and for anybody, it's a very important discipline. Tight stops means, when we were talking about the trade this morning, 48.50, you would have gone up, down, up, then it violates it, so you stop out, and you take a loss of it's $10 per penny. So let's say it went down 5 cents on you, 50, so you lose $50, okay? Then it goes back down. It doesn't cross back over, so you don't play. It goes all the way down to the next 50 level. Now you can play again, but you play the cross over, not under. So it comes back over, and you play it, and this doesn't count because, frankly, I would never cash that out. It didn't even get to 25. Then on the way down, you take another $50 loss, and now you're down $100. But look what happens the third time. You make the play, and it goes up without hesitation all the way up to a $500 win. So you net $400 doing it this way. Not how I did it. I play this. I went in. Now, I would play it that way, except I don't have time to be watching it all the time, so I can't stop out. I know you can set stops. I hate setting stops because they flush them out when you set the stops. I don't play that way. And also because 2 contracts for me, I don't care if I win $200 or $500. It's not a big deal. I want to win thousands of dollars. So for me, I'm willing to risk losing thousands of dollars to win thousands of dollars. So the way I play it is I buy 2 at 48.50. Okay? It goes down, and it went down to here. Now, if I had caught it being weak, I would have stopped out. I'm not a moron. But I didn't catch it. I was working. I'm writing my article. At 8:30, 9 o'clock, I'm totally right. I'm doing 100 things, writing, talking to people, all kinds of stuff. So there's no way I'm sitting there staring at this thing. So then it goes down, and it gets to here, and I believe I added 2 more over here, and I brought my average down to a bit, like 40. I think I probably added 1 here and then 1 more on the way down here. But I brought my average down to roughly 48.25. Then went down here. I don't add. I'm just hoping to get even now. I want to see it get back to 48.25 or something. So when it comes back here, it didn't get back to 48.25. Went down further. I added 2 more. So I added 1. Then I added 1. Then I added 2 more down here. So I had 6, and my average was right about 48. So when it got back to 48, I don't think, wait, not 48. I'll tell you what it was. Oil. Yeah, 48 sounds right now. Oil trader, blah, 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 blah. Oil. All right, so I'm up $1,000 at 48.50. So yeah, so I'm right. Basically, yeah, so basically my average got down to 48. Now, notice what I did though. I got back to 2 contracts. When I hit 48.50 here, I took 2 back off the tail. See, I said 6 by 4. I bought 6 long. I sold 4 short. So when I I added. Make this go away. Yeah. So I came in here. Not here. I'm sorry. I came in here. Let me blow this up a little bit. See if you see on the other chart. Came in here. Did not stop out here. It got down to here, so I added. But when it failed, I added again. When I thought it was hitting a bottom here, I added again. So if I added here, I had 3, and 50 cents less is maybe 49.25. My average was down here. So I have 3 at 49.25. Then I add another one at 48-ish, and that brings my average down to right about 48 on 4. And then I added 2 more down here at 47.75, and that brought my average right about to 48.50 on the 6. But then when it gets back to 48.50, I'm sorry, I don't know. However it worked out, my average ended up being 48. Obviously, by the math, I'm profitable by $1,000. But at some point, my average. I'm sorry. My average on 6 only had to be slightly below. I'm sorry, because I made $1,000 by selling. So my average on 6 was somewhere around here, probably 44.25, and that makes more sense. My average is about 44.25. I'm sorry, 48.25. I wish it was 44. So by the time I got to 6, my average was here. Then when the 6 went up, I made the money off the 6 being that high. That's how it came to $1,000. And then I stopped myself out of 4 of them because I accomplished my goal. My goal wasn't to make the money on 6. My goal was to lower my basis on my original 2. So now I have 2 at a nice low basis. And again, if it drops $1, if it drops to 47.50, I will be thrilled to add 2 more and have a 48 average on 4 contracts. And then if it drops down to 45, I wouldn't even mind adding a few more down there. I'd be down like $10,000, but I'd be happy because I have so many contracts at such a cheap price. But that's playing with conviction. That's because I really firmly believe that we should have an event within a month, July 4th, where there will be pressure to move oil and gas upward. Just like we did last week, finally, after waiting and waiting. So on RB, I did something similar. I'm not going to go through the whole thing again, but it's the same concept. On RB, it's also C6 by 4. And on the gasoline, I'm up 11.42, so about the same. And it was the same concept. It went down, I added. Then it went down some more, I added some more. It came back to here, and I go back to 2 because when I was even, I went back to 2. Or I'm sorry, not even actually. When it broke back over this line here, and as soon as it failed that line, I took a stop out. Oh, and also there's another reason I took a stop out. I took a stop out because I knew I was going to start a webinar, and I always lose money on these webinars because I don't have time to pay attention. So I said, I want to get back to 2 because I don't have time to sit there and stare at it. But I don't mind if these 2 go back down. I don't mind. I'll just add more and restart the cycle. Now, can it go against you and against you and against you and you lose tons of money? Yes, that does happen occasionally. But in the non-scientific statistical survey of my lifetime of trading, I make 1,000 here and 1,000 there very consistently all the time, and once in a great while I lose a bunch of money. But the times I make a few $1,000 vastly outweigh the times I lose $10,000 or so. So on the whole, it's a winning play. But that's, again, if you can't do it randomly, you have to have a reason. My reasoning is oil and gas sold off because of the Libyan bill. Very important. So to have the conviction in the first place, we talked about it earlier this morning. We were talking about why did oil go down? Oil went down because Libyan production is ramping up, and also because of the deep well drilling we talked about over the weekend. We're following this thing constantly. So the cost of deep water drilling has gone down, which means there will be more oil pumped from the Gulf of Mexico, even though prices are low. And that's bad. That's bad for OPEC. That's bad for the glut of supply of oil. There'll be more and more oil coming out of the U.S. And OPEC didn't cut enough to offset the gains in oil from other places. So, though we're long in oil into the July 4th weekend, after July 4th, there's no catalyst into the fall. I wouldn't touch oil, on the long side. I'll be happy to short it probably, but I don't think oil is going to make 60. It'll be amazing if they get back to 55 at this point. They have totally blown it. And in the winter, we could be back in the 40s very easily, the low 40s. So that's how that works. Let's see if we have any questions on that since I just explained a lot of stuff. Oh, I thought that was off. Hang on a second. Somebody's trying to get me. I don't know who it was. It seemed important, and both phones were ringing at the same time. All right. So where am I? Yeah. Jim's here to lose money. All right, Jim, let's go. We can do it. So where were they? Who's keeping track of this thing? Oh, yes, right, other trades. So I still like oil long. I still like gasoline long. We just think that there's a reason for it being long, that the overall the market forces. Now, don't forget, there's no oil inventory today. Tomorrow we're going to get oil inventory. Tonight we're going to get the API report. They may be disappointing. I don't know how much travel was really done the holiday weekend. But that's not the point. The point is it's already priced to be disappointing. When you start getting near 47.50, that's a real good support line. So it's something worth playing. But as I said, coffee, natural gas got really cheap, probably for no good reason. And coffee, where's coffee? Coffee. Here's coffee. Coffee got cheap too. I mean, we always like coffee up the 128 line. We were talking about that earlier. Now it's 129, unfortunately. But for the purposes of the webinar, I'm willing to take a trade. Can't always, since we unfortunately start at a certain time, we can't always get ideal hits. Like we talked about this earlier in member chat, though. Very, not hard to place a futures trade. You just go into the thing and you go ahead and see a little that says buy. Watch this. Now it doesn't say it. Why didn't? There. He says buy. So there's buy, and if I go on this side, it says sell. It's very simple, right? And here's the bid, here's the ask. They're 5 cents apart. So it actually matters. It's actually quite a lot of money, 5 cents on a coffee contract. So you want to try to wait. Now, since there's 3 here and 1 there, I don't see how there's your pressure. More buyers than sellers. So here, oh, damn it, would have been a good price. But now there's 13 and 1, so I'm going to wait. Hopefully it'll push down the other way. Thinking. 14 and 5, not looking good, going the wrong way. 15 and 5. 15 and 3, uh-oh. 11 and 2. 11 and 1, I'm going to get it. I got it. Whew. It's definitely not, it wasn't liking the way it was going, so I decided to take it. All right, so now I have one at 129.15. I'll be very happy to add another one if we get back to 128 something. And also on, not gasoline, what was the other thing? Coffee and natural gas. So on natural gas, this contract is a shorter term contract. This is NG. I want to go for the V contract, V7, which is October. That takes us into hurricane season. So, a couple of long-term factors for natural gas. They're exporting it by LNG, liquefied natural gas exports is picking up, so I like the long-term trend for natural gas. Also, it's going to be a strong, theoretically, obviously, a strong hurricane season. It's been many years since we've had a really good hurricane in the Gulf. And you have a hurricane in the Gulf, it shuts down a lot of production, sometimes for like a week, and that causes a huge draw, and that can really spike natural gas up. So the best thing about natural gas playing it into the fall is if you get a hurricane, you get a big spike up. If you don't get a hurricane, it doesn't make a big spike down. It's not, see, there's no event that's going to dump a bunch of gas onto the market. There are events that take a bunch of gas off the market. So the risk-reward is in your favor, all else being equal. So if you get a decent entry point like this one, so we're at just under 312 here, and I'll take one. I'm going to take two because I really like it. Now I got too long. Now, got to look at the bigger picture too, though. You always have to know how much damage can I take on this trade. So we go out to natural gas and look at the days, and see here, it's not really good support. Now, keep in mind, I went for the longer-term contract. It was more expensive. It was 312, not 307. This is not great support. If we fail 3, I need to get the hell out. I don't want to lose this. I don't want to get to 250 and be down 5,000 per contract at 350. I'm sorry, 250. So I'm not, I don't want to see a move like that and natural gas go against me. So I would get out here and wait, and then whenever it seems to find a real bottom. So, knowing that there's very little support here other than the natural support of the $3 line. So if it comes close to $3, I might add a couple more, but as soon as it goes below 3, I get out and take the loss. That's on natural gas. Now on coffee, our premise for coffee is super long-term, but global warming is causing a coffee shortage. It's causing crop disruptions, and that leads to spot shortages. And you don't know when it's going to happen. Sometimes it's, and also though, I'm sorry, also it leads to surpluses. Some places, this is the funny thing people don't understand, some places are having bumper crops of coffee because the weather is warmer than usual for coffee and they're getting better seasons. Other places are having too hot, too dry, and they're usually good coffee seasons are turning dead. Now, the problem is, not a problem, the opportunity is that the places where coffee is usually good outnumber the places that are getting lucky. So in other words, the places that are getting lucky are not logically, the places that are getting lucky because of the hot weather are not the places that always grow the most coffee. They're the places that grow some coffee, but it's not ideal, so they don't grow it as a principal crop. Although over time, over years, they may change that because they say, geez, this place is getting to be great for coffee. But the reality is the places that are great for coffee are becoming not so great for coffee. That's where the problem is. So there's lots and lots of coffee being grown in places that are getting too warm for coffee. And that's a problem. And that doesn't fix quickly. But it also doesn't break quickly, so it's a long-term trend. And it's funny because we were talking about global warming this morning. And something came up, and I looked up a Neil Tyson video, the physicist, and he was explaining global warming. And it's the same thing for charts, because what he said about global warming is he said, look, there's a big difference between the climate and the temperature. And he said basically the climate is like the moving average. So he says your climate is this. In other words, he says, imagine a person walking along a beach, and here's the ocean, and here's a cliff, right? And he's walking with a dog. And so the guy is obviously, if he has to walk along the beach, he can't go this way, and he can't go that way. Here's the ocean, he can't go in the ocean. Here's the cliff, he can't go up the cliff. So he's going to go this way. He's going to go that way. It's fine. It's a fact. There's no alternatives to him going this way. It's clear as day to anybody who understands what people, the capability of a person walking it is. It's not subject to debate. It's what a person walking does. If they have to go in a certain direction and you have a cliff over here and the ocean over here, you know he's going that way. Now, if he's walking with a dog, though, and he says the dog is like the weather, he goes, the guy walking with a dog, you can predict his movement pretty well, but the dog is going to go this way and that way and up and down, and he's going to run to the water, he's going to run by the cliff, he's going to chase the rabbit, he's going to go up and down here. So he goes, this is what the weather is. And he says the weather can vary a lot, but still follow a path, which is generally following the man, and the man is like the climate going straight up. And this is the same thing in a chart, because in a chart, you have your 200-day moving averages that tell you what a chart's really doing. Okay? This one went up, peaked, and went down. The day-to-day stuff doesn't matter. What matters is what the big trends are looking like. So here on this chart, we're completing. We had a big trend up, came back down. We've completed a cycle. Now we need to have a bigger view. So we take a step back and take a bigger picture look at the thing. So in the bigger picture, well, let's look even bigger picture, bigger picture. Coffee was down, it went up, it went down, it went up, it went way up, crazy, went down, went way up, went down. Now it's back here. But over time, this trend is moving just a little bit higher. Just a little bit higher. People are drinking more coffee over time. We're also growing more coffee, though. And that's why you have such crazy things. We drink more, we grow more, whatever. So it goes up and down. But what you have to do is look in the bigger cycle and think about where are we and what's driving this at this moment, the short term, the weather of the thing. What's happening in the short term? So what I'm saying here is that I think we're kind of doing this. I think we're going to make a little W pattern here. And as you can see, we're in a big W. Here's a W, right? And we went kind of off the rails, but now we're forming another kind of little W. And so we might go lower, but ultimately I think we're going to be back up here. I think it's much more likely we end up around here in the 200s, and especially why? Because of the global warming, because of the irregularity of the crops, because of the increasing consumption of coffee, because a billion people in China are discovering Starbucks. You have all these tea drinkers and coffee in China and India. And why do they, and you know, they drink tea. But you know that people market stuff. Like we've got them eating hamburgers now, which is terrible, by the way, because they're consuming way too much meat. They were perfectly happy being basically vegetarians, and now we've got them eating hamburgers. It's really stupid. But why do they do that? Because of marketing, because McDonald's tells you to. Okay, I mean, as an American, when we were kids, I remember my cousins from England never had a hamburger before they came to America. And we were like, what do you mean you never had a hamburger? They're like, what the hell is it? It wasn't food. It was in the 60s. I'm like, that wasn't food. McDonald's, the advertising, they made it food. I mean, obviously they had them in diners and things like that, but it wasn't something the rest of the world ate. You market something, okay? You have to push it. Kentucky Fried Chicken wasn't a thing. People ate fried chicken, but it wasn't a thing that somebody would say, oh, I've got a craving for fried chicken. Everything is marketed. And coffee is being incredibly marketed. Starbucks is a machine that markets coffee, just like McDonald's was a machine that marketed hamburgers. Coke was a machine that marketed soda and got the whole world drinking soda by advertising it and pushing it. It wasn't a normal drink. Soda wasn't served, like Louis XIV didn't have a soda jerk. It wasn't a thing. No matter how rich you were, nobody said, oh, I can get soda. It's all, you put together something, you make flavors, and you market it, and that's how you create the demand. So global demand for coffee is going up and up and up. And if there's any interruption in the crop, it won't change the demand for coffee. Right? That doesn't go away. You get people to start drinking coffee. It's kind of hard to get them to stop. It's a little addictive. So the long-term trend I like in coffee. I'm willing to ride out the dips to get there. This is when we started buying coffee. We only started getting interested in coffee down here. And we had a wonderful run up here. We cashed out most, and now we're just kind of playing this little, now we're playing the weather, the daily ups and downs. You know, we make 5 cents on this. We're going to be thrilled and get out. We're not going for the big win yet because when it bottoms, I think when it bottoms, we'll know that it bottomed. I don't think it's bottomed yet, but it's still going to go up and down because that's like that little dog, right? You go back to the short-term picture like that, and there's your little dog just running up and down and up and down. So when it goes down, it's like a leash, right? You assume there's a guy in the middle here, and the dog ran that way, but on the whole, the trend is heading that way. Even if it's going flat, it's still too far down now. And if we can catch a few cent move on it, that's $1,000 or so. That's all we're looking for in these trades. Just quick little wins, get out, start again. They're always going to move, and you're always going to be able to play something. And we talked about natural gas being the same concept. But natural, and again, both of them is the catalyst. One catalyst, global warming, long term, not going to go away. Natural gas, we're exporting it long term, not going to go away. So when we have long-term patterns that we can count on, it feels a lot more comfortable getting on the correct side of the trade to get started. Butterfly positions, Microsoft. Didn't we just review these portfolios like last week? We still have USO. I will take a look. So we have USO July 9 calls. I think we do. What are your thoughts on the FXP June 9 calls in the OOP? All right. Well, let's look at the OOP first. There's the OOP right there. Not making any progress. We're very neutral in the OOP right now. It's at 186. It's been at 186 for ages. USO, we have these 40. Well, the July 9 calls. We have our premise is July 4th is going to be the big weekend. So yeah, they went down a little bit, but not markedly. So we're fine with those. And what was the other one we asked about? FXP? FXP, we have the June 24th. Those are not being good to us. They're down 113. And we're probably going to roll them for time. I don't want to do it just yet. But we'll probably roll them for time and move out to a longer position like September's or something like that. You know, you want to take advantage. I'm not sure what FXP looks like at the moment. Hang on, I need one of my charts. Who took that picture? That's funny. Yeah. Not that chart. That chart. Speaking of moving averages, copy. Well, not copy. Opening new tab. There we go. Now we look at FXP. All right, so basically it's been doing the exact opposite of what we think, but what's our position? We have the June 24 calls. So the question is, do we think we're going to get our $2 back by June using this chart? Well, it only has to get back to 26, and we have 30 days to do it. Not quite, but whatever amount of days it is. So can it get back to 36? Well, sure, it could, because it was there only 1, 2, 3, 4, 5, like not even 2 weeks ago, it was over 26. But I don't think we're going to get rich off it, so I'd rather buy more time. If we buy more time, I could easily see us getting to 28. So what does more time cost us? What do we have to 24? So we go to FXP. And we look at what we have, which is the June 24th, and they are $1. Wow, look at this spread is terrible. They're $1.23, about, and then we go to the September 24s, and they are also hard to say. I'd say about $2.25-ish. So it costs us $1 to buy a few months till September, or we could go with these guys, which are like $3.50. The 20, what are these? 22s. We could pick up the 22s, which are $3.50, and we can sell the 26s, which are $1.29, so $1.30. So $3.50 minus $1.30 is 220. So we'd still be spending $1, and then we'd be in this spread for about $3 total. But we'd be in the 22, 26 spread with FXP at 25. So it would only, so basically we would have spent the amount of money that we're in the money for. But I don't love that, so I'm not going to run out to do it. It's like I would much rather just cash it out if we get a nice bump up. If we don't get a nice bump up, then we'll roll, and then we'll cover, and then we'll turn it into a spread. But the point is just to say, if you don't make your money on your position, then try to figure out a way that you can do it with it. Then say, how can I do this and not lose money? I say, well, okay, I can get into a much more conservative September 22, 26 spread, and I'll pay more money than I paid so far, but it's in the money, at least it's a good spread. And that same kind of logic applies to looking at these, Microsoft and Costco in the butterfly position. That sounds like a convincing reason to be long on coffee. Yes, I love my coffee premise. But again, because unfortunately it's literally based on climate change. Climate change is a super duper long-term phenomenon that you cannot possibly know what's going to happen in a short-term amount like a year. Even a year, you have no idea if it's going to be hot, cold, warm, whatever. So at some point, I expect more global warming to cause problems in coffee. So I will keep playing coffee. At some point, I expect a nice run-up in coffee due to a problem in production. I don't know when, though. It could be this year. It could be next year. That's why coffee actually, we came up with this premise last year. That's why coffee was not our trade of the year. It got nudged out because we just couldn't figure out the time frame. It was too tricky. For the trade of the year, you got to say it's going to happen now, not going to happen like 10 years from now. But what I'm saying is just generally there will be more issues and more disruptions going to happen. It's more likely there'll be more disruptions in coffee than there'll be more bumper crops. Although right now in the spring we've been getting a bunch of bumper crop reports. So we'll see. But as I said to people before, in the springtime now, you're getting the harvest from the bottom half of the world, where for them it's fall. So their summer's ending. And they're doing the harvest. So their harvests are good. But they don't make much coffee in the bottom half of the world. More coffee is made in the top half of the world. So what matters is our summer and our harvest, not theirs. But everybody's trading off of what they're getting reports from like South America and stuff like that. Butterfly positions. We have a USO. We'll talk about that. What's our upside target for USO? Well, we think now we don't think gold is going to go so high. So if we look at USO, okay, realistically, look at last July. Last July was at 12. I don't think we're going to get there. Oil's now at 48. So I think 55 would be the most. That's 7 into 48 is some exact number that I can't think of. It's like 7 times 8 is 56. 7 is 49. So 49, 7. Okay, it's not an exact number. All right. So basically, it's about 15% that we're looking to gain. So if you take 15% of that, you're going to get $1.50. So $11.50 would be basically where we think we're going to be. So shy of where we were last year. So and then you say, oh well, here's the 200-day moving average is at 1030, and is 1080. So it's going to be hard to get over 1080. So we're going to be really happy if we get up to $11, we're going to be thrilled to just take that off the table. We're not going to look for $11.50. We're not going to be greedy. We get $11, we can get out. Okay, we said we get back to the butterfly, so let's take a look at that. Okay. Butterfly's getting killed in this position too. Well, it's not so bad. So what's that question? It was Costco. I remember Costco. So Costco, we sold it July. It's not July yet. We sold it July. 165 puts and calls. We sold them for $12. $9.05 for the calls. $3 for the puts. We sold the 165. So at what point do we start losing money? We lose money at 177. It's at 179.61. So we're not losing very much money here. And if you look at the net here, plus 4,000, plus 1,200, minus 33, plus 1,100. So we're actually up net on the spread. There's nothing to really worry about here. It's not July. We think the market's going to correct. If the market corrects, this number can come down. So there's certainly no reason to do anything on that trade. You have to look at the whole trade, not just the part that you're losing money on. So, and again, look, here's the steady movement of the stock. The 200-day moving average is a steady movement of the stock. Here's what the stock does around, like the dog running around. Here's what the stock does around the 200-day moving average. So you're saying, here, look at the pattern, up, down, up, down, up, down, up, down, up. And now you're saying it'll never go down again. That's it. We got to get out of this thing. We got to sell it. We got to change it. Even though it went up and down and up and down and up and down and up and down, now I think it's not going to go down anymore because I have it. Because it's mine and it shows a loss in my portfolio and I'm freaking out. That's a terrible reason to do something. The business did not change. And not only that, though, but it usually does this on its own, and it usually gets this high. It usually makes 2-3 boxes higher than the average, right? 1, 2, 3 boxes higher than the average. So now, even with a gigantic rally behind it, it's only doing the same thing it usually does. That's not really strong. The whole market is doing this. All they're doing is following the market. They're not even on their own making a good gain. They should be outgaining the market if they're in a really good up cycle. And look at the way they come down, too. Violent. So what am I going to do? Am I going to tighten up at 180? And then go have it violently go against me? And then what am I going to do? Am I going to then freak out and sell it again? No. Hey, we sold it. We picked a target. We picked a target right here. And that target happens to be the 50-day moving average. The 200-day moving average is way the hell down here. So our target that we picked is where the 50-day moving average is. We made a very accurate prediction of where we thought the midpoint should be. It just happens to be above the midpoint now, but it also does not happen to be July. It's not even June. It will be tomorrow, but it's not even July yet. So let's give it the time and see what happens. All right. So what was the other one? Microsoft is the other one. The hardest thing I have to teach people is not to touch things. Be patient. Let your positions play out. I know it's hard. I know you feel like you're not doing anything. You have to have a hobby. The worst thing you can do as a trader is sit around staring at the screen all day. You have to have something else to do. Okay? Good trading should be like watching paint dry. You set a trade up and you do nothing. That's it. You set your trade up. You just watch it go. And you don't have to win everything all the time. You know, in the options opportunity portfolio, we have things that go in both directions. Well, you saw it a minute ago. Anyway, so we have all these trades going in all these different directions, but the gist of it is on the whole, and again, it's just the same thing as the chart. On the whole, it does this. At any given time, it goes up, it goes down, it goes up, it goes down, it goes up, it goes down. You know, could I try to fight that? Could I try to stop every little, loss and try to prevent it? You can, but you just end up over-trading and shooting yourself in the foot. But if you leave it alone, it will naturally go up because we are being the house, because we're selling the premium, and the only thing we know is that over time we will collect our profits. That's the only fact that we know for sure. We don't know if each individual stock goes up or down. We have no idea. But what we do know is every single option premium we sell will expire with no premium. The position might not be worthless, but we still make the premium. So where are we now? Walmart. So in Walmart, isn't that one that's broken up into pieces? Yeah. No, Microsoft. Okay. So with Walmart, we have two. I see what happened here. We have two positions. What we sold is these June puts and June calls. What we own is we have a bullish position in Walmart. We have the 65 calls. We sold the 72.50 calls. Oh, this is not even one you should be worried about. And we sold the 55 puts. So we have an aggressively long position with a target of 72.50. That's in the money, so we're not worried about that. It's 30 contracts. We sold half as many contracts, and our target was 67.50. It's at 78. We sold the 67.50, 65 for $5. So that means 72.50 is where we start losing money. We're at 78. All right, so we've lost 6 times 15, it's like $1,000. We're down about $1,000 here. The position itself is down $12,000. Wait, 62.50. No, 72.50, 78. So that's 6 per contract times 15. $1,000. Why does it show such a huge number? Okay, sorry. It's $10,000. So $10,000. But look, we're making 19,000 here, losing 12 there. So here's 24 down, 19, 24, 23. So the net of this is $2,000 plus on the position. We have. This is only June. We have a year. Oh, I'm sorry, this is the 2018. We're going to end up having to move to a longer, we're going to have to move to a 2019 spread here and roll these along. All right, so how do we fix it? We look at the Walmart 67.50s, June. We still have plenty of time to fix it, so we're not worried about it. In fact, what it's doing is it's protecting the huge gain we have on our long position. So the 67.50s here are $11-ish, and the September, the 70s are $9, and the January, still 70s and $9. So what we'd want to do is probably roll to the 70s. And they're only at 70, what are they at? 78. So they're at 78. So we probably want to roll to the 70s, sell some puts for $1, like the $75 puts for $1.30. So that's essentially getting our $11 back, right? It's almost $11. So we can even sell a couple of extra and come up to 11. And then we will take our longer position and roll it to something else that makes money when if Microsoft goes higher. And at that point, then, all right. So let's be realistic about it. So these puts will expire worthless. They already are pretty much worthless. So this position here is 19 plus 5. No, 20. I'm sorry, it's more like 20. 25,000 profit here minus 12 is $13,000 profit. So we're going to cash the $13,000 profit, and then we're going to pick up a position in 2019. Like, where are we at? 78. So let's say we pick up the $70 calls for $11.50, and we sell the $80 calls for $5.50. So that's $6. So we could buy 20. We could buy 20 of those with the money that we're cashing in. So now, if Microsoft goes up to 80. Our net $6 will turn into $10. We'll make $8,000 more profit. And if we sell some puts, like the $70 puts, I don't think I want to sell $70 puts. Let's say we sell 65 puts for $280, and let's say we sell 20 of those, that's another $5,000. So now we have a $13,000 upside if Microsoft holds 80, and we would have the short, we'd be covering with the short $70 call. And then we keep rolling them higher, and the only way that we could lose money on the short calls would be for Microsoft to go more in the money, which means we're making $13,000 or $12,000. 13. So we're making $13,000 here. So the only way we could lose any money here is to make another $13,000 on the long. And you know what? We can do that the year after the year after the year after. And if every single year those short calls want to burn me for $10,000, and every single year I make $13,000 on the longs, I can live with that because it's a net profit. And this year, in a real situation, we made $19,000. And you're never losing the other money because you're just rolling it to the next year. You could eventually take the loss, but by the time I make the loss, I make 19 plus 13 plus 13 plus 13. So you have like $50,000 profit, and then you say, okay, I guess I'll take that $10,000 loss now. Because all it's doing is covering your gain. When you take a bullish position on the long side, all the short positions doing is covering your gains when it goes in the money. There's nothing tragic about it. There's nothing that needs an adjustment. And again, we think there'll be a correction before all this happens. So we're not in a big hurry to do anything. Although I think I might want to take the profit off the table on the Microsoft though, this way. Or is that Walmart? Sorry, Walmart. I might want to take the profit in Walmart. But we liked Walmart. That's why we got more aggressively long on them. We liked them. We thought they were going to go up. We didn't think they'd go up this much, but we thought they'd go up. But all these, that's what's great about the butterfly portfolio. It's very, very adjustable. That's why it's such a steady winner usually. Not lately, not recently though, because we had a couple of ones that blew us out. But they'll come back, and then we'll have a good month instead. Okay. We talked about FXT, right? The time to just up in the OOP. Up is not doing good. Up. It's never time to adjust something, frankly. It's only time to adjust something about once a month is when I like to do, like as far as adjustments, I like to do review and adjust. But, yeah, obviously it's not doing good, and it's June, so we are going to have to, probably next week, we'll have to take a look and see where we are. But, yeah, obviously it's not doing good. So we're going to have to decide if we want to move it, do we even want to stick with the long dollar. Because the way the Fed's acting and the way Trump's people are acting and everything like that, they're trying to make the dollar worthless. Not that Europe or anybody else is trying to make their currency stronger, though. It's just a race to the bottom, really, the way they're handling it. Tesla Model 3. Well, I predict the Model 3 will be delayed, and we are sticking with our Tesla shorts, which are totally killing us in the short-term portfolio. Thank you for mentioning that. Jeez. What a horror show. It's funny because overall the short-term portfolio is not getting hurt that badly, but because we have other trades that are working out. But the Tesla, 337. We sold the 324. Fortunately, there was only 6 of them, and fortunately, we sold them for 14. But they're now 21. So we lost $7 a pop on those guys. We're down $4,000, and we're also down on the short on the long puts because those are completely worthless. But what are we going to do? We're going to roll these to a longer-term spread and play them into earnings because I think the Model 3 will be delayed, and I think that's going to be hopefully a last straw, and people are going to get fed up with these guys. Because they still have given absolutely no indication that there's any problem at all with their schedule on the Model 3. And now they've only got about a month until it's supposed to be rolling out. But meanwhile, I see no indication it's actually ready either. Like usually a month before you put a car on the road, car and driver and the Consumer Reports and people are testing it. That's not happening yet. So all the most you're going to see at earnings is a prototype of a Model 3. There's not going to be, I guarantee there's not going to be any delivery. There are no June deliveries. There will be no third quarter deliveries of the Model 3. And if they promise fourth quarter deliveries, they're probably lying anyway. But the people are playing these guys like they've got everything under control, and I seriously don't believe that's true. What else? Boy, I'm glad we sold those puts. Look at that. Wait. Oh, no, we didn't. Wait, June 20 put. Sold it. IMAX. I just did the whole thing on IMAX. Aren't you in the chat room? Where did we do that? Oh, here. Aren't you Batman? I'm not going to get into a whole thing on IMAX again. Look, IMAX, the short story on IMAX is they're killing it in China. Although the problem in China is they have to do, like every Chinese company, you have to be a 50-50 partner with the Chinese company. So unfortunately, they only own half of all these theaters they're rolling out in China. But, and the way Chinese deals are structured, they're probably paying all the money, and all the Chinese people have to do is sign their name to the deal to show you have a Chinese partner. But the bottom line is, anyway, they're rolling out a ton of theaters in China. And people in China are loving IMAX. It's a huge thing over there. You don't even know, these are, we're kind of, not racist, whatever the word is. We're America-centric. Because we don't care what the top movies in India and China are, do we? We don't even know what they are. We don't watch them. We don't care. We're not interested. There could be movies in China making double this amount. We would have no idea. It's completely ignored. They care about our movies. We don't care about theirs. We act like anything that's not in English doesn't exist. So there's a whole other box office on the other side of the planet. But meanwhile, you read a review, and as I said over here, analysts are idiots. Some guy who knows little, if anything, about the movie business, certainly doesn't understand the IMAX business, comments that, well, box office receipts are down, therefore IMAX is down. That makes no sense. They have very little to do with the conventional box office. And also, as I pointed out, these are the IMAX movies. Beauty and the Beast, Guardians of the Galaxy, Logan, Fate of the Furious. Those are the IMAX movies. King Kong was an IMAX movie. This was not, I don't think John Wick was. Power Rangers was not. Pirates of the Caribbean, IMAX movie. And this one only came out 1 week and it's got that much money. So it's going to be up here. So basically, assuming this one hits the top 5, they will probably have all 5 of the top 5 movies in IMAX. And those movies are doing fantastic. The rest of movies are doing badly. There's a lot of dogs this year, but IMAX doesn't care because they don't put dogs in IMAX. Unless there's been a huge mistake, which happens sometimes. Like, what was that one that just came out that was a bomb? I have it, now I lost it. It was some hero thing. It wasn't Captain America. Damn it. King Arthur. Oh, that's why. No wonder I couldn't think of it. I'm like on the wrong track. So King Arthur just bombed. But it wasn't an IMAX film. So yes, when a major motion picture comes out like King Arthur and bombs, that depresses the box office because movie studios only put out a certain amount of movies. They don't put out dozens and dozens of movies each. They have, their budget is X, and they put out the movies, and they hope they get their money back from the movies they put out. But they can't put out double or triple the amount of movies they put out last year. It's not a volume business. It's really a quantity business more than anything else. Quality business. They've got to get their money back per movie. Not all movies have to be blockbusters, but when you spend $200 million to make a movie, you better damn well make $500 million in the box office. Otherwise, you're never going to see your money back. So anyway, the IMAX films are special, and IMAX participates. Anyone can make a movie in IMAX, but IMAX doesn't have to show the movie just because he made it in IMAX. IMAX decides what movies they want to see, and obviously IMAX will decide based on the fact that you shoot it in IMAX is a very big thing. So question number one, they're going to be like, did you shoot it with an IMAX camera? If you shot it with an IMAX camera, then there's a much better chance they'll play it in an IMAX cinema. They don't have to. They have movies that are transformed to IMAX from film, but generally IMAX likes to use the IMAX cameras because it obviously gives you a better shot on the IMAX screen. So, obviously the top four movies, they know they're going to be blockbusters. They know it. And that's the thing. There's a certain cost involved in that. And the Hollywood studios aren't idiots. They know when they've got a sure thing, and they spend the money for the IMAX. If they don't know they have a sure thing, they don't spend the extra money to film it in IMAX. And it's not just the camera, because if you're going to film it in IMAX, then your set has to be 20% wider. That's important. You don't think about that because it means you have to have certain sound stages aren't going to be good. Everything becomes you run up all your costs of the film because you can only shoot on a bigger sound stage with a bigger set, with more actors and more scenery. It's a more everything because you've got this big wide super camera that has ultra high resolution, which also means you can't skimp on the details in your costuming and makeup and things like that. So, deciding to shoot in IMAX is a big decision. And it's not one they make for bad movies. It's not one they make for Boss Baby. Okay? And they don't make it to Get Out. Well, that Get Out actually this is probably the most profitable movie on there. I think they probably made that for like $25 million. So, you never know. Oh, look how happy Universal's got to be, right? The Split, that couldn't cost much money. Shades of Darker, I don't think that cost that much money to make. So Universal, very clever. That's NBC. That's Comcast. So they're having a good year. And this is Disney. The top two films, Buena Vista is Disney. But anyway, so it's a big decision to do that, and you have to have a whole thing that you're going to do to decide. Oh, Buena Vista's down here too. But they know what movies are going to play out in IMAX. Like Wonder Woman, IMAX. They know it's going to be a big blockbuster that's coming out on Friday. So anyway, the problem is people they review it and the crux of the review that was down on IMAX, of course, it's dropped today, was that movie box offices are bad, therefore IMAX won't make money. That's idiotic. They're in almost a different world from the rest of the movie. So we just added it last week. Anyway, we added some more last week. Now it took a tumble, but really only back to where we started buying. We bought it when it did this last week. Then it went back up, and now it went back down to where we started buying it. So I still like it here. The same price I liked it last week. Okay. And Learner says, got it on the butterfly. Yeah, it's the process, and the problem is, the problem is that you have to do it over a couple of years to really start getting it. Because after a couple of years, you go, oh, I don't worry about these things. They work themselves out. You start realizing that on the whole, it tends to work out quite nicely. Because things do tend to revert to that line in the middle. And when they do, that's when you cash in. You don't know when it's going to do that, though. There's the problem. You don't know when, like we're playing this line with our targets. Not necessarily, but I mean conceptually, we're playing a line. And we pick our targets every quarter. We pick a target. So we pick a target here, we pick a target here, we pick a target here. Doesn't matter what the target is. And sometimes we're right, and sometimes we're wrong. Right now we're wrong. At this moment. Doesn't mean we'll be wrong in July. It means we're wrong at the moment. But at this moment, we're wrong. But all that matters is that one time, when we hit the right time, when we're in the right place and it's the right time, and we intersect and these things expire worthless, that's the jackpot. That's when we get a huge reward, because then we pay nothing back. And if that doesn't happen, we simply roll the positions along to the next target we think is likely, and hopefully we hit that target and we get nothing back. So the point is, we get to try over and over and over again to hit our target, and there's no real penalty for us losing other than a paper loss. But one time, we only have to be right once, and we win all the money. And we only have to be kind of right to win most of the money. That's the beauty of it. But it takes time. But it's super unlikely unless we play Tesla in the butterfly, which is why we don't play Momos in the butterfly. But unless you're playing something like Tesla that goes up and up and up and up. Well, even Tesla doesn't go up and up and up, though, but conceptually. Okay, from this perspective, pretty much. So unless you're playing Tesla, which goes up, and then it goes up more, and you're trying to target it, if you play Tesla here, you would have hit it plenty of times. It just sort of got away from people here. But you know what? It's probably going to come back again. It's just a question of how patient you can be. It sucks to look at your portfolio and see a great big loss like, Tesla, I'm sure is a, all right, like, SQQ is a hedge, but $20,000 loss on SQQ. We have a $10,000 loss on Tesla. Where's our Amazon? Somebody have Amazon? Amazon, we got a $10,000 loss over here. All right, it sucks to see a position that's losing $10,000, but it's only a loss when you cash it out. The $400,000 portfolio. Okay, so we first of all, it's a hedge. Oh, and by the way, if the market does fall, and these are just dead, we're giving up on this thing. If the market does fall and this reverses, and if that one reverses and the Netflix reverses for $20,000 loss, and the SQQ reverses for $20,000 loss, that's 50, and Tesla reverses for $10,000, $60,000. So, without even making a profit, simply if the market reverses a little bit and these losses go away, I'm not talking about a profit, because they can all make as much as they're losing, but we would make a quick $60,000, 15% in this portfolio we could make in a day or two, just by a reversal of those. That's part of our hedge. If the market goes sour, we will make $60,000 like that. And then if it gets worse, we'll make another $60,000 because we will start making profits on those same positions that are currently showing losses. That's what the hedge is for. So yes, we're going to lose money while it's going up, but the long-term portfolio makes money when the market goes up. And we don't touch that at all. Talk about not touching something. We never touch that, other than adding things to it. And that's up almost 180% now, 1.4 something. Oh, 1.383. And 1.383, most of it's cash. 1.1 million is cash. It started out at $500,000, not even 3 years ago. And they're all off because the shorts are in the other portfolio. So if this thing tanks, if the market drops and this thing drops $130,000, if it falls 10%, the short-term portfolio will pick up half of that money immediately. That's what a hedge is. And your hedge has to be in proportion. So of course, when we make $130,000 in the long-term portfolio, we're going to lose $60,000 in the short-term portfolio. That's how it works. You can't win both ways. And this is why people hate hedging. People want to win everything. And that's also, by the way, in the butterfly, the biggest problem in the butterfly portfolio is hard to get your head around. Every position is its own hedge. That's why we don't have hedges in the butterfly portfolio. They're all hedges. We're betting against ourselves all the time. We sell a call. We sell a put. we buy a call, we buy a put. They're all against each other. We don't care whether things go up or down. We care about making the money on the premiums that we sell. It's not about making money being right about the position. It's about collecting the premiums every single quarter or every single month or however often we sell it. It's quarterly now because the VIX is low and you can't get enough money for the monthly. But every single quarter. And by the way, that's the funny thing about the butterfly. You guys don't realize that. The butterfly portfolio in a low VIX environment is not as good, nowhere near as good as it is in a high VIX environment. When the VIX is high, you sell everything for much more premium. You make a fortune. So again, this is also a 3-year-old portfolio. It's up 200% in 3 years. And this is a terrible environment for the butterfly portfolio because the VIX is so low. But it's all about selling premium. The whole concept of this portfolio is nothing but selling premium. Just keep selling premium. If you always sell premium, you will make money. You won't make money on every bet, but you will make money because you're beating the house. Never be upset that you're paying off your gamblers. That's what keeps them coming to the casino. Buy them a drink, in fact. Offer to fly them back in a private jet. That's what casinos do. It's not about winning or losing. It's about getting them to keep playing. Because as long as they keep playing, you will eventually make your money. So a new trade on Tesla. I frankly, we're stuck in it, and we have a fairly small position, and we're going to roll it. But I would not really, I don't know if I'd add a new trade. I tell you, it's just really annoying. So my target price on IMAX, Batman, is higher than it is now. That's my target price. You know how I play things. We play things to not be down from where they are. So we have an IMAX position. I don't know why you keep asking the question. The IMAX position in the long-term portfolio, which I'm sure is probably even or not even better than even. Oh, no. I didn't do it. I'm sorry. Damn it. I mean, we called it, but it hasn't been entered. We already have the short puts, which are a better sell now than they were. And then we just added a bull call spread. That's all. I still like the target, although you can go further out in time now. But it's the same thing. You sell some puts, pick up a bull call spread, play not to go any lower than it is now. It's at 24 now. Certainly it's going to go to 30, so like the 20-30 spread, something like that. I forgot what our official play was, but it was something like that. Jay says, if you have time, could you show how to do a quick fundamental analysis of the company? A quick fundamental. It's kind of like. Imagine you say to a doctor, if you have time, could you show me a quick heart surgery? Don't worry about being good or not. Just get it done, so I can check off some boxes. It's like, well, step one, go to medical school for 6 years, okay? Then come back. Then we can start talking about some of the basics. But quickly. Here's Apple. This is random. They want $800 billion for this thing at $152. $800 billion. What are they doing to justify $800 billion? Let's look under the hood. Well, they have $200 billion in revenues. And obviously, by the way, to everything here, I'm not going to go over the whole thing, but obviously you want to go quarterly. Do the quarterlies indicate that they're keeping up with the $200 billion? So the annual goes to 9/24/16. Are they still on that kind of pace? Well, let's go back. So the annual included this 90, but in the first 2 quarters here, they got already 80, 130. And assuming they do another 90, they're on a path for 220 at least. So it seems like they're certainly still on the same kind of path. All right. Now, this is very interesting. Look at the cost of revenue came down nicely. 52, see here, 52, 32. Notice here, 46, 29. So they have 52 million here and only 32 million here. So actually, they're keeping their costs nicely under control. And here you got 48, they're 12 lower here, which is 25% lower here. But the revenues are not 25% lower because 25% of 78 is 18. Oh, no, that'd be 60. That's interesting. I take that back. Wait a minute. Am I wrong about the number? No, it isn't. It's 18. So 18 less here is 60. But here they drop 25%. I'm sorry, it's not. It looks good here, but it's not good here. So we don't know what the fluctuation is. That's what I want to find out about that and see what happens. It did impact their gross profit. You can see it. Anyhow, you want to make sure they're still on track. The revenues are still on track. A profit's still on track. Income, 8, 17, 34, 35, 36, 46. So 46 billion-ish is 12 months worth of income. So annually, yeah, okay, 45 billion. It's the same as last year. It's not better. Now, that's a random snapshot of 4 quarters, though. It doesn't mean that that's how their fiscal year will work out. Well, the point is they're at least on track. So they're not very different than they were last year. So that's one thing we can see. But they are getting a better value than they got last year, clearly, for roughly the same amount of sales. So now we're going to look at some analysts and see what the analysts are saying. And we have 30. How many analysts? Well, 38 analysts. That's a lot. So you assume this is a fairly accurate sampling. Although, you look at the high and the low, and you want to see how far apart it is, and in this case, this is crazy. Next year, the high is 1250 and the low is 9. That's crazy. The average is 1047. So on the whole, people think they're going to make 15% more money than they did last year. That's huge. Next year they think they're going to make 15% more. Now, I want to find out why. Now, we know why, because these new iPhones are coming out, new iPads, they're in a new cycle. So everybody thinks that as it's starting in the fall, when the phones roll out, they're going to start making money hand over fist and increasing. Plus, they've got several other projects that they're starting to pay them money. I think the low guy must be crazy. So what are they doing? They're making $8 a share here. They're making $8 a share here. I'm sorry, it's last year. They're making $9 a share here. They're making $10 a share here. $10 a share times 15. So their P is around 15 going forward. All right. Do they usually beat their earnings? Yes, they do. They beat. Okay, that's good. All right. Now we want to look at the financials again, and we want to take a look at the balance sheet. And they've got some cash. That's nice. 20 billion cash is good. Short-term investments, 66 billion. That's not bad either. Receivables don't count because anybody's got receivables that's payables, and they generally cancel out. They don't worry about that too much. But you want to see that they cancel out, but that's business. Okay, your payables and receivables tend to more or less balance out. Inventory doesn't matter. Certain types of businesses matter more than others, like the Sears inventory matters. Total assets here. Then they got this. They go, whoa, wait a minute. They have $170 billion in long-term investments. That's really rare. So now they have $46 billion in short-term, $170 billion, that's $210 billion. And their market cap for the whole company is $800 billion. So 25% of the market cap of this company is investment money. And that's what their overseas money and all that bullshit is. Everybody they're hiding overseas. So they've got 25% of the market cap of this company is cash. Therefore, the price earnings is really 25% better than it seems. Because they've also got cash. If they shut the company tomorrow, they would distribute all that cash to the shareholders. Now, what do they do with that cash? That's something you got to look at cash flow and say, well, what are they actually doing with this money? It seems like a crazy amount of money. They only had 130 billion 2 years ago. Now they got 170 billion. So are the investments making money, or are they just putting more cash into investments? And the same with the short term. Look at the short term. 11, 20, 46. These guys are doing better than Buffett. And it's incredible stuff, actually. All right, so then you want to look to see, is there anything weird going on with payables? And payables are basically flattish. They're fine. Debt's fine. Liabilities, nothing special there. Blah, blah, blah. Long-term debt, nothing. Well, not that. The long-term debt's been creeping up. That's interesting, right? For some reason, they borrowed $22 billion more last year, and they borrowed $27 billion the year before. What are they doing with that money, I want to know. Other liabilities, not too different. Total liabilities, and you can see up here, went up quite a bit. So that's got to be on your checklist to say, well, what? Yeah, and that's what you want to do when you're doing these things. If I was doing this for proper analysis, you want to start writing down things like that. Why did their long-term debt go up so much? You want to take notes. And there's a thing called Evernote. And what you can do is quickly, you can cut and paste. You can quickly cut something out and paste what you saw. And then that way you have a reference that reminds you. So you can actually cut out this section and paste it and then put a little note in there and say, why is that? Why is your long-term debt going up? And then if you follow through on all those questions, you'll really have a much better analysis of what's going on. So we have then the stock, the retained earnings, and the equity. None of this is that important. Now you want to go up to cash flow. And so what's their net income? Net income is going basically flat for 2 years. And again, you're just looking for what's weird. Did anything weird happen here? Receivables went down, receivables went up. Liabilities went up, then they went down. Inventory flat. Boy, inventory is so flat. That's weird. How can the inventory be so zacked all the time? Operating activities, not much change there either. Capital expenditures, roughly the same every year, increasing a bit. Investments, increasing. I mean, that's a lot. $44 billion change, $32 billion change. They're putting a lot of money into investments. So again, why? What are they investing in? You're buying the company. See, when you buy a stock, you got to think like you're buying the company. And if I'm buying the company, I want to know what you're investing in. What are you doing with my money? What purpose are you doing this with? Why are you taking $32 billion and putting it into what? So if you're going to do a proper analysis, you need to drill down into that and find out what are these investments and do you approve of the investments? If you don't, why were you getting into this company? So the cash flow from investing is all going out. Their investments are increasing, but it's because money is going out. And as you can see, the change in the cash is not much. So what they're doing is they're taking all the profits they make and effectively putting it into more and more investments. Now, it turns out when you analyze it, though, that the investments are really kind of like their weird little way that they stash the money overseas and don't pay taxes. So they want to show these losses. They're also, by the way, buying back astounding amounts of their own stock. $44 billion here, $34 billion here, $30 billion here. That is $110 billion worth of stock. It's only an $800 billion company. And in 3 years, they bought back $110 billion worth of stock. That's like almost getting towards 15% of the stock. So they're buying 5% of their own stock back every year. So you know what that means? In 20 years, in 17 years now, in 20 years, Apple will cease to exist. There won't be any stock left for you to buy. They'll have bought all their own stock back. They'll be a private company if they keep going this pace. Now, there's good and bad to that, because you think if you're a shareholder, if you're a long-term shareholder, and you intend to be the last guy to sell to them, that's great. But if you're a short-term shareholder, What the frick do you care if they're going to buy back, if they're taking that company private using your money? That's not a good thing. I know it hasn't really affected it. I don't want to say it hasn't affected their stock price. Their stock price would be way, way higher if instead of buying back their own stock all the time, they actually put it into stuff that made money and they showed a bigger profit. But they don't want to show a bigger profit because they'll give it to the government. They don't want to give the government any money. So they put everything overseas, they shuffle things around, they show a smaller profit than they actually have, and they do things like buying back their own stock and taking the company private. Now, it's not terrible. If you own a stock and they buy back their own stock, it boosts their earnings per share because there's less shares and the same amount of earnings. So it's also not that terrible if you're a short-term investor, but really, most companies, when they're doing things like this, it's not good. Apple can't help it. They make so much money. Look, they have nothing else to do with it. They're buying back stock. There literally is not enough. What do you do with $50 billion new dollars? Half of Bill Gates' entire lifetime fortune, half of Warren Buffett's entire fortune, every year drops in their laps. If Bill Gates and Warren Buffett suddenly went out and spent $50 billion, you'd notice, right? Apple has that problem constantly. They've always got to figure out what to do with $50 billion more dollars. The money is flying into the door. Every week, another $1 billion drops in their pockets. They run out of things to do with it. All right? So, and else is Apple, good company. Let this be your problem, okay? Buy Apple, and that's your problem. You have to figure out what to do with $1 billion a week. Oh, the beige book. I forgot all about it. Thanks. All right. Very quickly with other stuff then. Tesla. Yeah, Elon Musk said Tesla was overvalued last week. Didn't help. Nothing helped. What's the difference between VIX and SPXY? SPXY is like a blend of futures contracts on the VIX. The VIX is the VIX. The VIX is whatever it is now. SPXY, and you can't really, well, you can use the VIX for hedging. The VIX is an ugly thing. SPXY is a futures consensus on the VIX. So it doesn't move the same way as the VIX. It'll be slower to go down and slower to go up generally. In this particular case, we had a big spike in volatility last week, and it caused SPXY to go down and not really recover because now people are getting a little bit more nervous and volatility might come back. S&P just started dropping. I assume the beige book isn't that great. My account is $25,000 in the American trade with 10-year stock investing. They're not giving me level 4 options trading. What do you recommend? I recommend getting more money. I think that's probably their issue is you don't have enough money. 10 years of investing, only $25,000. Wait, you need to invest better for one thing. That's all you got to show for 10 years of investing? Come on, man. Let's get you on a better track for starters. Look, I'm level 4. I think it's probably naked selling of shorts and puts and things like that. Just try to, there's a reason they have these levels. And first of all, $25,000, you can't even day trade. So you have a limited of things that you can do anyway, and you have very little margin, so you shouldn't be taking heavy margin positions anyhow. You really got to stick to the basics. I mean, look, my advice to people who have $25,000 and they say, what should I be trading? My advice is just trade something really simple and go get a job. Go work. Take the money, take the time you would be spending trading and get another job and make another $25,000. And then after that, when you have $50,000, invest both of that, invest the $50,000 sensibly, and go make another $50,000. And then when you have $100,000, then you can start playing with it. But $25,000, even if you make 30%, 40%, 40% is $10,000. You could make more money working than you can trading. And working is for sure the money goes in your pocket. Okay? Trading, you might go the other way. That makes no sense. So TD's not wrong. I mean, not enough money to really go that way. It's like better to build up your wealth first, and then you can worry about playing with it. And there's simple things you can buy. We just started a new app, which I'm not really ready to talk about yet. We have a few people experimenting with it, but where we're doing simple stock trades with very, for people with small portfolios. We have the options opportunity portfolio, which is generally, good for smaller traders. You just want to have simple positions that are safe and long-term that will make you 10, 20%, maybe 20% a year. Things that you're going for, like a nice, simple stuff that we use all the time. Don't want to go for the stars, because what you really want to do, hopefully you're young. Hopefully you're not 70 years old and you have $25,000. So hopefully you're young, and if you're young and you can work, the best thing to do is work, let the money make it 10, 20% a year, and that'll double up after every 5 years. It'll double up, and then you'll have, in 10 years, you'll have $100,000 whether you want to or not. And if you put some money away and you make it $200,000, then you start getting to levels where it's worth like sitting around trading and trying to make something out of your money. But don't get ahead of yourself, because otherwise you're basically just gambling. And that's not worth it. And that's really why the brokers steer you away from it. All right, so let's see what happened with the indexes, and then we'll take a look at the beige book. Oh, up and down, huh? Fun. Oil, not enough of a pullback that I would want to add anything, but and also making no progress so far. Natural gas at least did start falling. That's good for us. And how's coffee doing? Coffee, we missed some ugliness in coffee, but it's right back to where we were. So we will see what happens. All right, beige book. Now comes the fun part. Oh, no. Don't want to lose that page. Fed beige book appears to boost the case for the rate hike. Okay, that's good. We'll take a look in a minute. Let's read the summary first. Economy expanded modest to moderate pace. Is this the beige book? Open that in a new tab. Give me some time. Oh, yeah. Okay, good. Generally upbeat beige book report by the central bank appears to strengthen the case Fed will raise the short-term rate as meeting in mid-June, which I've been saying all along they're going to do that, so that's fine. Most regions strong. Economy slowed a bit around Boston and Chicago. New York activity flat. I agree in New York. In fact, I was in New York with my kids. I was doing that NASDAQ show. And I'm very disturbed by how many open storefronts there still are. I mean, not since like the 70s when we had a financial crisis have I seen so many stores that are empty. In New York City, I mean, there's thousands of people walking by every hour. It's like a mall on steroids. And these people have money. Constant people and new people, tourists, fresh people coming off the boat with money. Sailors, literally sailors on shore leave, running around New York with money. They haven't been on land in a month, and they dock in New York for the Fleet Week, it's called. There are sailors everywhere this weekend. And they're running around New York looking for things to spend money on. They ship people in with money. The boats from all over the world dock in New York. It's like a big port that people like to stop in on vacations in the summertime. It's money just constantly flows into the city, and yet the people are not buying these beautiful stores that are open there. I mean, part of it is because the prices have never gotten realistic, because the market crashed, but the landlords didn't really lower their rent because they were able to refinance their buildings at lower rates. So instead of needing the money to pay their mortgage, to fill the building, usually a landlord will do anything to fill the building because they need the money to pay their mortgage and their taxes and everything else that they need to run the building. So even a crappy tenant with low money is better than no tenant. That didn't happen. What happened in New York is they lose a tenant, but then they would refinance the building at a lower price, and then they would leave the money, the rent on the building, they would leave it at some high rate that they used to have, waiting for the market to come back. They'd rather wait for the market to come back than put a new tenant in at a cheaper price. And that's going on all over the city. You see it. I mean, people, they have things for sale, apartments too, they have things for sale, but they're ridiculous prices. You're like, how many people on earth can afford these things? And the stores too. My daughter likes Dunkin' Donuts better than Starbucks for coffee. And we were talking about that. She's like, why are there no Dunkin' Donuts in the city? I'm like, you can't, selling a coffee for the price Dunkin' Donuts sells coffee, you can't afford to be in New York. You have to sell $5 coffees like Starbucks does. You can't sell a $2 coffee because you're not going to have 2.5 times more people buying your $2 coffee. Yet you and Starbucks will pay the same amount for the floor space. So Dunkin' Donuts physically can't afford to have stores in the city. They have a few, but I mean, generally they can't afford to be in spaces the way Starbucks can. Because a tiny little Starbucks store in the city will make $1 million. Because they'll serve 200,000 people at $5 a pop. Dunkin' Donuts will serve 200,000 people at $2 a pop. They'll make $400,000. They're $600,000 behind Starbucks. The same people, they have the same customers. They'll get the stuff. It's not like they're a worse business, but they charge less. You can't have a business that charges less. And that then sucks for the people who live there, because that means only expensive stores can afford to be in your city, and it prices you out of your area. That's what do they call it? Gentrification. That's how gentrification works. So, rich people come into an area, rich people go to rich stores, the rich stores pay more rent, you squeeze out all the small stores, and now you only have nice restaurants and expensive stores, and all of a sudden all the regular people can't even afford to be in the city. That's what's going on everywhere around. But, like I said, though, the disturbing thing, though, is that, you can't say things are really coming back if you have that many empty storefronts. I mean, I don't know, pick a number. I would say 5%. If I had to guess, I would say something maybe to 5% of the retail space. I'm sorry, I don't know what's going on inside the building. 5% of the floor, street level retail space in New York is empty. That is crazy high. I haven't gone to Boston lately. I haven't been to Chicago lately. But New York I found disturbingly empty. And I'll say that about Paramus, New Jersey also, another place where there's tons of retail activity. Also, huge amount of empty places. That's not a healthy economy. Because what does that mean? That means there's 5% less jobs. Jobs that the retail people would put out, there's 5% less jobs. Those people are buying, there's 5% less stores, they're buying 5% less stuff. That means 5% less manufacturing, because even if they're not selling it, it still goes into inventory. There's still stuff. Think of the difference of an empty store that's available for sale, for lease, or a store filled with stuff. If it's a restaurant, there's a guy who makes an oven, there's a guy who makes the fridge, there's the people who supply the food, there's people who sell them the chairs, there's people who do the decorations and the lighting and the flooring and everything. There's so many people get put to work because this guy opened a store. That's not happening. Not a healthy economy. Okay, it's one of my issues with the market and everything else is it's not as healthy as you think it is. The real economy isn't that great. All right, beige book, blah blah blah. The Fed diagnosis was more subdued, but growing labor shortage is part of the reason. In Chicago, business labor market was tight and difficult to fill positions. And that's a constraint also on growth, though. It's hard to add stores or add businesses when you can't find enough people to fill them at the right price. And, there was this great article. I forgot what it was. It was in yesterday's chat. Somebody did the math and said that U.S. small businesses in America can't afford to hire workers. Because there aren't enough cheap laborers for them to make a going business. It's a problem. They can't raise their prices because people aren't willing to pay more. That's a low inflation, low price inflation. So they're not really able to pass along higher prices. They can't afford to pay the workers more. Their rents are through the roof. That's another problem. Their rents are crazy. There's only so much money. It's got to be spread around. I'm saying right here, companies have sought to address the shortage by raising wages, increasing benefits, spending more on training and other measures. But it's very tough to make money when you have to do all that stuff. Chicago attracting better applicants, improving retention for unskilled workforce by raising wages 10%. This is good, though. This is positive to the economy. The wages are going up, but they're going up in a way that they're hurtful to businesses. So good to the economy, not necessarily good for the stock market. So we're early April to late May. That's pretty up to date. Boston, I hate these anecdotal things. A furniture manufacturer says new hires is a major challenge. In New York, Broadway ticket sales are 10% ahead of last year. Even though, oh my God. Yes, prices are nuts on Broadway. 15% up in a year of the already ridiculous prices. But people are going because rich people have money. And rich people in New York will see every show. Every single show. Whatever comes out, they'll go see it. Because $200 ticket, nothing. Doesn't mean a thing to them. And it wouldn't mean anything to you. In fact, that's funny also. We were looking at apartments yesterday. Because, Jackie's starting to think about college and getting out of the house and all that. And so we were looking at the cost places, and she was just like blown away by how much money you need to live in New York City. I mean, there are places, the kind of places she likes, because we live in a decent house. So she expects cathedral ceilings. She wants to see a nice bathroom and a nice kitchen and modern stuff. I said, look, I pointed to like a dumpy place across the street. I'm like, Jackie, that is your reality. You're looking at fantasy world over here for $15,000. I said, where are you going to get $15,000 a month for a 2-bedroom, 3-bedroom apartment? She goes, well, I have a roommate. I'm like, and where are you both going to get $7,500 a month? I said, what on earth are you going to do to make $7,500 a month coming out of college? It is crazy. That's just the rent. I don't know how people do it. I really don't. But now New York is weird about that, though, because New York, once you have a rent, the landlord, because of rent controls, they really can't raise the rent very much on you. So the landlords try to get, whenever housing comes back, and it's been back for a while now in New York, when housing comes back, they just try to get as much as they possibly can. So a lot of those prices you can negotiate down. But they're just hoping someone's going to come in there and take those places, so those prices, because whatever price you get is effectively locked in. You're basically never going to get much of an increase. So there are plenty of people in New York living there now who've been in the places for 20 years and are paying like $1,000 a month for a gorgeous apartment. Because 20 years ago, that's all it cost. Now, if they leave it, the landlord will immediately run it up to like $6,000-$7,000. But they just can't, because of the rent control laws, they can only give like very tiny increases every year. So because of that, they try to make it up by charging an incredible amount now. In the Cleveland region, auto dealer chain inventories of new vehicles hit the highest level. That's not good. That's unsold cars. In the Richmond reservation for summer vacations, popular Outer Banks running ahead. Minnesota region, high amounts of snow. In Montana, skiing, that's good. And San Francisco, growers say tighter immigration restrictions imposed by Trump. Substantial labor shortages for low-skilled workers. Yeah, no kidding. Farmers are throwing away part of their harvest. Oh, no. Well, that was obviously going to happen. All right, so here's the Fed. By the way, it's always important to know, San Francisco, look how big the San Francisco district is. You have to realize that about some of these districts. Cleveland district, not that big. Dallas district, not big, but Texas is big. Minneapolis is a big Fed. Kansas City is big Fed. These guys are all small Fed. Or Atlanta's actually big. But these guys, Chicago, Cleveland, St. Louis, are actually relatively small. Boston's relatively small. New York and Philly is very small. Philly Fed is the smallest one. So, you get these reports sometimes, and you have to kind of wade in, like, how big is that district really anyway? by far the San Francisco thread, because obviously California is a huge population. That's a huge district. That includes California and Seattle and Nevada. Well, Nevada's got a decent amount of stuff also. So, you have the San Francisco Fed is huge. The New York Fed is big only because New York activity is so gigantic. Boston has a little bit of weighting. So all of New England is Boston. But Richmond, none of these states are that big. Atlanta's okay because it's got Florida or whatever. Dallas, Texas, like I said, is huge. But these guys are all small feds. So you have to weight that also when you look at the districts. You have to think about how big is the actual district you're talking about. Now let's see if we can make that bigger. Control plus a couple of times. How's that better? Huge. All right. Economic activity. Stand modest to moderate. Most say modest to moderate. Chicago growth has slowed somewhat. See, this is the thing. If you have record highs in the market, slowed somewhat should not be a word that is used in a Fed report, right? Flattened is not a word you want to see with all-time highs. Consumer spending softened, with many districts noting little or no change. Auto sales have edged down from last year's record highs. Tourism continues to keep pace. That's interesting. I've heard tourism is off. I didn't see any evidence of that in New York, I tell you that. Nor to my trip. I'm going to England and France next month. Everything's booked. It's almost difficult to get rooms in some places. So I don't quite see where they think the tourism is that far off. Meanwhile, they ban laptops, so I might never get on a plane again. If it's not laptops, if I can't bring my iPad on a plane, unless they reinstate better entertainment systems, I'm really going to leave it. I kind of depend on that now. Majority districts, moderate growth in manufacturing, construction of new homes is moderate. These are not the kind of words you expect in a record high bullish market, right? Lending volume trends continue to mirror the general activity. What does that mean? Agriculture conditions are mixed. The wet weather, although it's wet weather, as we were talking about that earlier today, the wet weather is impacting crops, like it's ruining the crops. It's too wet. So you might see some bumps in corn and stuff. We don't play that really, but it's an interesting thing to watch. Hang on. Market. Or maybe not. Energy sector is improving. Now, this is not a good thing because the energy sector is improving, but we know now that oil's turning down. So that improvement isn't going to go the other way. Yeah, it seems like the market's kind of drifting along. Labor markets continue to tighten. We know that. Pricing pressure, little change is very important. Most districts, modest price pressure, rising costs for commodities. Input costs are high. See, the input costs are higher, but they're not really passing it along. That's going to squeeze margin down the road. Falling prices for final goods, including groceries, apparel, and autos. So people can't afford stuff, is the bottom line. And there was a great article today about people super cut back on lunches. Restaurants are getting killed because people aren't eating lunch out. They're bringing bag lunch from home because people are needing to save $10 or $20, whatever you spend for lunch. That's how tight the consumers are that they're bringing bag lunch. And you know how much it sucks to bring a bag lunch to work. It's like people are bringing bag lunches to work. Energy prices, farm prices are mixed among the districts. Low inventories of some homes are pushing the prices higher in many markets. And then, I hate the way they do it now. Well, so looking at some of the more important districts, Boston, overall economic modest. See, overall economic growth was modest. But the markets are record highs. With only half of retail economy reporting year-over-year gains, only half have a gain in revenue. Housing market's strong. Labor market's tight. So my cost of having a business is going up, costing me more money to be in my business, costing me more money to employ people. But pricing pressures can't raise my prices. So outlook remained positive, but added caution. That's a turning of sentiment a little bit there. Economic activity flattened out in recent weeks. Labor market tight. Wages continue to grow. Input price pressures have remained fairly widespread. Selling price increasing at a modest pace. Well, at least it's not increasing. Housing markets have been steady on bounce while commercial real estate has been mixed. But Philly, like I said, who cares? Who cares? Who cares? Who cares? Who cares? Okay, so here we go. Here are some important ones. Economic activity improved. Labor market remains tight. Firms visa training programs, an uptick in wage growth. Retail sales soft. We're getting the same story over and over again. Sales of cars, trucks remain solid. Okay, that's good. That's one of the few places where car sales are good. Manufacturers noted an increase in new orders and production. Look, the bottom line is this is not the kind of report you expect to be reading in a record high market. It's silly. That's why the market is not improving right now. This is not a glowing report. This is not a report that makes you want to buy things. So I'm not going to read the whole thing. You get the gist of the report. It's okay, but it's not good enough to make me think the market's going to go up another 10% from here. Batman, asking chat. I can't start doing personal analysis for companies. It's not going to have time for that. With the ban on, in fact, what time is it? In fact, we have 7 minutes. So, with the ban on computers on overseas flights hurt a company like GoGo? Yeah, isn't that their whole thing? So yes, you're right. That's actually something we should be concerned about because it's in one of our portfolios. Where do we have GoGo? That's a good point. Good catch. Go. Here they are. Yeah, you know what? We should dump it. Just in case. Because you're right. If they ban everything from planes, what's the point of these guys? They have a huge impact on their thing. Good catch. Who's that? That's Tim Schroyer, folks. He made the call. We're getting out of GoGo. All right? That's definitely a good idea. GoGo is going to be gone. I like him. I like what they're doing, but he's right. That is a fundamental change in their business proposition. And, well, this has been weird. But basically, they've been on a good path. We've been very happy with them. We haven't had a reason, but this is a good reason that it could conceivably. And why should I hold something when it's already up like a good amount? It could conceivably run into trouble. And if they do, we'll reevaluate and we'll pick them up again. But the fact that I could see a possibility more than 10% that they could actually crash all the way back down to the lows, why should we stay in it when we already have a good profit? So GoGo is gone officially. We're going to say that. All right, cool. Anyway, so where are the markets? Let's see what's happening. All right, so on the whole, we look for strong and weak bounces. So on the whole, 2150 down to 2950. So that's 200. That's a 200-point drop. Now we're back at 983. Wait, 930. Is that right? 20,009. Yeah, 200 points. Okay, so 200 points. Now, this is 2983. Am I doing this right? Yeah, cool. Wait, 2150. That's 50 points. That's 50 points. I'm sorry, it's 100 points. Silly me. All right. So this is 100 points down. And this is a 40-point bounce. Now, interestingly, that is exactly on the 5% rule, right? 20% bounce is weak and a 40% bounce is strong. So this spot right here, this line, is a strong bounce line. And what happened? We went down, we overshot a little to the bottom, we overshot a little to the top, but on the whole, we're failing at the strong bounce. And so you can assume these are all strong bounce lines. So we're failing all at the strong bounces. We're actually consolidating for a move lower on the indexes. We're not moving up. We're consolidating for a move lower. And it's very possible that we're just being held up because it's the last day of the month, and we may start off June with some selling. All right, so be really careful out there. Oh, I did this morning. I had a link. Let me see, make sure it works. Yesterday on TV, I was on something. There I am. Okay, here's the link. Great. All right, so yesterday I put the link right here. It wasn't very clear that this is a link, but this is a link. And we talked about 3 ways to hedge the NASDAQ specifically. So in this broadcast, I talk about it. So you can click on that and hear me talking about it. But the actual positions are here. These are, and this was in member chat 4 p.m. last week. We talked about how to hedge the NASDAQ. And I said you can do the future short, which is already a very good trade today. I said we can do the future short, and you can pick a September contract. So watch, NQU7. I was talking about the September contract at 57.96. Let's see where that is. So NQ, that's the NASDAQ. U7 is the September contract for next quarter. And it was just about 5,800 when I talked about it. Why is it seem so slow? Come on, thing. Oh, I broke it. Oh, there it is. Okay. So, as you can see, I was talking about shorting it at the 58 line, which is right here. And we were over it this morning, so no problem getting in. So I was talking about it back here. And again, it's the same thing. It's a tight stops concept. You want to be tight stopped over it, but then when you break under it, because you're limited, how much can you lose? If you have a stop at a few points up, you can only lose 50, 60 bucks a time, right? But now we're under it, and we haven't come back over, so you're hedged. And even now, just at 15 points down, you're up 300 bucks per contract. And if we fall all the way to here, that's $10,000 per contract. Actually, wait, 58, 55, yeah, that's $10,000 per contract at 55. So you, excuse me, the hedges, the beauty of the hedge when you do it on a certain line with a tight stop, if you're only risking 50 bucks, 50 bucks, 50 bucks, but the amount you can make if it drops as a hedge to hold insurance in your portfolio, it dwarfs your potential losses. That's the beauty of the tight stop system. You pick a good line that has a good support, and you say, okay, I'm going to do it with tight stops here. Like let's say here, the 57 line, same action, right? At 57, we had this behavior. We had the same move up before it fell off the shelf. That's where we are now. Move up. I predict the same, falling off the shelf. And that went down how much? From 57 to 55.50 is 150 points. So we're looking for possibly the same move would be back to 56.50, which is down here. So it'd be 150 points times 2. That'd be 3,000 per contract at that price on the NASDAQ. So that's what I'm saying. You know, if you take a few $50 losses, that's the cost of your insurance. If it does hit, though, and you get that 150-point drop, you're going to pick up $3,000 per contract as a hedge. That's why I like those kind of trades. So that was one way to do it using the futures. Using the ETF, QQQ, I said we can do a bear put spread, buying the 147 puts and selling the 136 put. So you're buying the 147s, which are in the money way up here. You're selling the 136s at that target down here. And the net on that was $475, but the payoff is $11 per contract. So you buy 10, you pay $47.50. You have 11,000 up. Your upside potential is $6,000, about 150% gain. And all the Nasdaq has to do is move here. The beauty of this trade, though, is because you're at 142 when you start, or 141. The beauty is you're already $6,000 in the money. You are more in the money starting the trade than you paid for the trade. The only way you can lose money is for the Nasdaq to go higher. The only possible way. If the Nasdaq goes higher, then your longs go up in money, and that obliviates your loss of insurance. That's what makes it a great hedge. Then another hedge, and this is the one kind of that's in the short-term portfolio and the options up to portfolio, is to take a bullish spread on the inverse ETF. So if the Nasdaq goes down, these guys go up. And at $30, we were talking about taking the 35-40 spread. Why do we do that? Because it's cheap. It's only $1. It's $1.10 per contract. So we were talking about buying 10 for $1,100. That gives you buying 20. Wait a minute. 65 minus 54 is 11. These numbers are wrong because it's 2,200. It's 11 for 10. It's not 11 for 20. This would be $2,200, but it's a $10,000 spread. Your upside is $7,800. So it's 700%. I mean, 350% potential gain on that. Not that much because I did the math wrong. But the point is that you get a very small spread that only costs $1.10 per contract. We did 20 of them. That would be $2,200. The spread is then $10,000 with a $5 spread. So very, very small gain in SQQ. $5 on a 3 times ETF. That's $5 here is 15%. That means you only need a 5% drop in the Nasdaq to hit that number. So a 5% drop in the Nasdaq pays you 350% or 400%, I guess, on the spread. That's really good. And you can offset that, and I talked about that, you can offset that by selling some Gilead, I still like Gilead, by selling the $55 puts. Gilead's at $65. You sell the $55 puts for 2019, which are way out here, for $2,400. That pays for your entire spread. And so if Gilead, it doesn't matter what the Nasdaq does, if Gilead stays over 55, if Gilead doesn't fall 20%, you have a free insurance policy here. That's what I like about those trades. And also, even better, though, the Nasdaq could fall. You can make your money on your insurance policy. Then the market recovers, and you make your money on the spread, and you even do better. That's how I like to play those things. That's my favorite way to play, which is why they're in our portfolios. These are the quickie ways to play, and of course, we do like our future short. And that's all we have to do to make money. All right. Tim, brilliant call. Very good. Thank you for pointing that out. I should have thought of that before. But yeah, I was real big. That's the kind of thing we want to look for in fundamental trades. Like, did anything change about the business? And here we have something drastically that could change about the business. What if half as many people can take laptops on a plane? Okay, how many people are going to pay $20 just to be able to use their phone? Way less, right? Or $10, whatever it costs. People are going to be way less people. It's a blown business model. If they really ban everything, it could be. And you don't wait until they do it. The fact is, we made good money. We've got a profit. We can cash it out, and that's it. We're done. Okay? Our premise got a little bit shaky. Why stay in it when we already have a profit? So thanks for that. Thanks everybody else for coming. We will do it again next week. And I don't know. See you then. All right? Thanks. And this one's recorded, so we will have the copies. All right? Take care.